Hello, this is Jed Brewer with the Below the Line Club and Study Groups. I hope you're having a wonderful day and hope you're staying warm at the same time. I know a good portion of the country is in the middle of this polar vortex. We've got a little bit of snow on the ground out in Bellingham, Washington, where I'm at today. Well, really excited to have this webinar. We're going to be talking about mergers and acquisitions and state of the industry of what's taking place on the M&A side, as well as having a brief legal update, some tax implications perhaps, and other legal considerations to talk about. It's important for all of us to stay abreast of the trends that are taking place in our industry, and really pleased to have two experts here to lead us through. Both Spencer Cavalier, who's the Managing Director of Matrix Capital Markets Group, and Jim Dierking, he's a shareholder at Winthrop and Weinstine out of Minneapolis, but they last year stepped us through the mergers and acquisitions and legal consideration. They've done it for a few years in a row, and really pleased to have them agree to do this again this year for us. I know it's highly rated from people in the audience. So Spencer, just a brief bit about Matrix Capital Markets Group. They're sort of the gold standard in my view as it relates to an M&A brokerage house, but help people put deals together, particularly on the sell side, but do work on the buy side too. And then Jim Dierking, Winthrop and Weinstein's a large law firm out of Minneapolis. They work in a variety of areas, but Jim specializes in particular in the petroleum convenience sector. And then Winthrop and Weinstein and Matrix Capital Markets Group work a lot together on deals where Winthrop might provide the legal counsel and Matrix be the broker, deal maker at the same time. So you've probably seen these two around in the industry, but really great guys and good people. So with that brief introduction, let's just get right into it. But want to say to you as the audience, we want to make this educational. We want to make sure we can get your questions asked and answered. So if you do have any questions, please type that into the GoToWebinar dialog box, and I can read those questions, and then I'll relay them to Spencer or Jim at the appropriate time, and we'll do our best to get your questions answered throughout. Also, just informationally, we are recording this webinar, and we'll post it onto our website afterwards, so you can see the slides and also the recording of this should you want to share it with a colleague or revisit any of the material. So with that introduction, Spencer, I'm going to turn the floor over to you and give us a brief update on what are the key factors and trends that are driving the mergers and acquisitions developments here in our industry today.
Yeah. Well, thanks a lot. We really appreciate the opportunity to be involved in this update again, and I'm real happy to be joined by Jim Dierking with Winthrop. Last year, Tammy Deem joined me, and Jim, welcome. Yeah, we have a little bit different spin on the legal section this year, so I think it'll be really interesting for the group.
And Spencer, you go ahead and share your screen, and then we'll be able to see your slide deck that you have.
Okay. I thought it was sharing. Could you give me the opportunity to do it? It should be sharing already.
Yeah, usually there's a little pop-up box that you collect for.
Yeah.
I'll make myself the presenter, and then I'll pass it back to you again here, Spencer.
Okay. Thank you.
Hopefully you get a little pop-up box.
Did I hit it that time? Did I do it correctly?
There we go. Yeah, now we're working.
There we go. Great. Okay, good. Okay, so many of you who have joined us in the past, we kind of break down the industry into different segments so we can cover there's a lot of different companies involved in Below the Line Club. And so we try to break it down into the C&G segment. Those companies primarily engage in petroleum and convenience retailing. And then the fuels distributors, mostly people that are wholesaling branded and unbranded motor fuels to retailers, typically contract dealers, commissioned agents, et cetera. Some of these folks also do transport loads to high volume retailers, but we kind of group those down in commercial fuels and lubricants below. And then we have the propane segment. Those primarily, engage in retail propane or wholesaling of propane. to residential or commercial, industrial, and agricultural end users. And then last, the commercial fuels, whether it be short truck or transport, and lubricants market, and there's other ancillary process fluids and additives that these companies do. And many of our clients have had, all or many of these segments under one umbrella, and that's kind of how we, generated our experience over the years. So we're going to talk about each segment. Not every slide in this deck is going to be covered because some are just leave behinds, and you can call me and ask me any questions you want. But we're going to hit a lot of the slides here. So going to the next screen, and we're going to start with these discussion topics. Obviously, industry trends and valuation update, which is kind of my section. Then legal considerations with Jim, and then some shameless plugs about our recent transactions, and then our bios at the end. And I'll note that Jim and I are rivals. I went to West Virginia University, and he went to Iowa State University. So we play a lot of basketball and football games against each other and have a lot of fun time kidding each other about that. So let me go right into, Jim, do you want to say something about that?
No, I was just saying indeed. And while I'm happy to talk about football this year, I'm not so happy to talk about basketball right now.
Exactly. So, yeah, we're lucky this year, that's for sure. But let's talk about the CNG market. And the general comment here is that M&A activity remains very robust. And because this segment continues to really consolidate. And I think many people on the call are CNG marketers. So what we try to do is break things down into what factors that are likely to be permanent and factors that are likely to change, and so we can update these trends, over time. And some of the things that have been on the permanent side of the box here for a while is the first one's industry maturity, and a lot of that had to do with motor fuels volume. And a lot of people talk about electric vehicles and the efficiency gains of the internal combustion engine. This is, becoming more concerning to people as, you see more and more announcements by GM and Ford to become, electrified. And if they don't want to make the investment into bigger stores to sell more products, oftentimes they make the decision to exit the market, exit the industry, and somebody else comes in and makes those investments or runs it in a different channel of trade. So it's very interesting. I think there was 250,000 light-duty vehicles, electric vehicles sold last year. They're projecting about 1 million this year. So still very light. But I think that just the gains in the traditional, combustion engine have really, the miles per gallon have really put a lot of pressure on motor fuels, which is still a big profit contributor to the P&Ls. We're seeing a lot of continued expansion by highly recognized C-store chains. Most recently you saw a surprise acquisition maybe by Murphy's acquisition of Quick Check up in New Jersey and the New York area. They were seeking bigger boxes in order to expand into food service better. So it was a marquee acquisition by them, and we're going to continue probably to see that as well. I'm going to skip down one bullet to the continual pressure from increases in wages. Obviously, this is something that we've seen for quite some time, but now it's picking up even more steam with the new legislation for a potential $15 per hour Fed minimum wage, and so a lot of our clients are trying to figure out how to react to that, especially if their state minimum wage is lower, and they're trying to figure out how gradual that $15 per hour minimum wage will be, come into play. So that's a focus of many of our clients. The needs of existing and soon-to-be public companies to grow revenues and cash. We're going to see some of the major consolidators here in a minute, but most recently we saw Arco go public through a SPAC. We saw the formation of Recharge Acquisition Corp as a SPAC, and then there are other potential companies that want to go public as well. So As they go public, they will need to acquire to grow and meet Wall Street demand. So it will continue to put pressure on consolidation. And so the more public companies we have, it seems like the more consolidation we have, and we have a chart on that here in a little bit. I'm going to skip down to some factors that are subject to change. We've had an incredible tax rate and just tax law structure for both sellers and buyers over the last few years under TCJA and the CARES Act. One of the big things for buyers has been the ability to do 100% bonus depreciation on eligible property, really the permanent improvements. And that's going to start to phase out 20% a year starting in 2023. And then there's just incredible uncertainty about the Biden tax plan for both, corporate and personal tax rates, capital gains rates. We have a slide later we're going to go over about that, maybe some scenario analysis on that. But nobody knows when this may take place or with the severity of the tax law changes, but we do expect there will be changes, most likely starting in 2022. The next bullet to mention is low interest rates, something that we've had here for quite some time, is something we thought that is subject to change. It seems like it's permanent because it's been down here so long in this section. But the Fed's recent announcements that they don't see major changes in Fed funds rates, et cetera, for the next couple years would seem to think that, make everybody believe and continue to believe that interest rates will be low for quite some time. And of course, cost of capital, especially a low cost of capital, really drives valuations. And so it's for people that are considering selling. It's very helpful for people that are buying. It lowers their cost of capital and makes certain acquisitions doable versus a situation where you have a higher cost of capital. And the next bullet, strong interest from the industry by private equity funds and international companies. In my period of time in the industry, which has been since about 1998, we have never seen as much interest from private equity and international companies in this industry or other parts of the downstream sector. We believe that they're seeking the strong dollar or a return on the strong dollar, and that it's a safe haven for many of these companies, especially international companies. The private equity funds see a great opportunity to roll up and make certain companies more efficient, and especially on the logistical side. And I think we'll continue to see this for quite some time. The next factor I want to talk about that's subject to change will be, the ability to sell with strong performance, especially retail fuel margins. We've had 4 to 5 years now of incredible fuel margins, and we're believers that the cents per gallon margin on fuel has moved up a level. It has to move up to a higher level to just cover operating expenses. So where the average U.S. margin may have been 15 cents a gallon in 2012, now it's 19 cents a gallon. We think it's going to stay up, but we've had this progression of increasing fuel margins over the last few years, and we rarely have had that type of progression for this amount of time during my period in the industry. So it's an ability for, I think a lot of sellers are looking at this, is that we've had we can sell into the market with higher margins, higher cash flow, and let's take advantage of that in case something happens to those fuel margins in the next couple of years. On the next slide, we talk about or show some of the companies driving consolidation. And as you can see, we talk about this a lot at Matrix. You can be in a high multiple industry or a period of time, but if you don't have a lot of liquidity, you may not be one of the companies fortunate enough to get a higher multiple or a good multiple, fair market multiple. But here today, we have a number of companies who are seeking to grow. And these are companies that believe that if they grow and consolidate to a certain level, the synergies make it worthwhile. And I mentioned under U.S. public companies, I had mentioned Arco Corp earlier, that's GPM Investments. In the major oil companies section in the middle, we're seeing more and more JVs. put together by major oil companies with retailers. So we just recently sold a company to a JV that was put together with Phillips and the Fortress Group, which is a large hedge fund. So you're seeing a lot of creativity, especially down on the lower right side under private equity. First Reserve has built up a nice platform of retail convenience stores, and we expect them to continue to grow. And other PEGs or private equity groups are looking to do the same thing. So on the next
for you,
slide,
Spencer. I'm just curious. A concern I hear from many marketers is electric vehicles, the decline of petroleum over time. And they say, hey, our window may be short with regulations and new administration and so forth. And they say, maybe now is a good time to exit. But presumably the buyers, I mean, these are sophisticated folks. They see those same trends. What do they tell you why they're buying in this industry?
Yeah, that's a great question. Well, I think a lot of those believe that the runway for carbon, right, is a lot longer than they're hearing. That most people believe. That's one reason. Or their business model is such that they think they can withstand, and convenience will be around forever, right? Whether it's food or other merchandise, and they'll figure out a way to bring traffic onto the site as long as they have good sites and a good offering. Others are very distillate focused, and they believe distillate will go a lot longer than maybe gas. And everybody's afraid of what they can't control, though, and they can't control the government regulation. I think that's the fear, that whether you're a consolidator or not a consolidator, maybe potentially thinking about selling. I think that's what worries you the most. And there'll be a number of special interest groups fighting back on electrification in terms of how it's done and how much money is going to go into fund especially government money going into funding the infrastructure of electrification. So I think that they just believe that over time they have a much longer runway, or their business model is such that it can withstand it.
Makes sense.
Yeah. And what do you hear from your study group members? Do you hear something similar, or I mean, you're talking to as many companies as I am. Do you hear a similar response to that?
I do. I think people the majority of folks seem to think the window is longer, and even if it is shorter, that there's always opportunities to diversify and find new revenue streams. We're energy providers, and we can be that last mile in alternative ways. I mean, whether it's, say, I'm convenience and I'm going to pivot towards that more, drive my break-even pool margin down, or what have you.
Right. So on the next slide, on factors driving consolidation and fuels distribution, many of these are the same, but I want to just pick out a few that I think that are important to remember. And that the second bullet here, large fuel distributors can capture additional profitability through superior purchasing power and operational synergies. We've seen, just in my small time in the industry, the procurement ability of larger, high volume fuels distributors, the ability to cook, just to procure fuel at a differential much better than a smaller fuel distributor or marketer is more significant than ever. And I think that's just because there's just more product out there, and again, the consolidation has limited the amount of outputs for a lot of refineries. So I think they're trying to work with larger distributors, and the larger distributors just have more negotiating power than ever. And we're starting to see, and I think this is not really new, but over the last 3 years we've seen more, that refiners are competing directly with distributors for large customers. So we've seen, for example, BP on the West Coast come into the market there in a more aggressive manner. We've seen Irving in and out of the market on the East Coast at times, and other merchant refiners become a lot more aggressive. So I think we're going to see that, and that's going to put more pressure on fuels distributors, especially those smaller ones, and they're going to have to either grow or sell to get bigger, to compete. And their customers are looking for efficiencies, and they want their suppliers to provide more services so they can, rely on them to do so. So, keep fill, electronic ordering, billing, all the type of technological advances that a customer wants. These larger distributors are making big investments into doing that and, tying their customers into them. The other thing that large distributors do is they just have access to a broader spectrum of fuels and other products that maybe a smaller fuel distributor does not, and so it gives a customer more flexibility as they're competing in different markets. On the factors that are subject to change, again, the taxes are a big driver here, and we're going to talk about that more. But one thing that we've seen, especially in fuel distribution, is that private equity funds have come in and out kind of a little more randomly than in CNG. Now they're very interested because they believe that there's a roll-up opportunity because many of these companies are seeking exit opportunities. And there's a big logistics play here that a lot of private equity funds tend to enjoy and think they are better at than most operators. So they see some low-hanging fruit. And a good example of this is often petroleum, which is on the second private equity investor, and they believe there's a lot of growth for them, in acquisitions. So I think they're going to be very active. But there's others out there that are very active, like Energy Capital Partners, et cetera, that are seeking to grow their platform. On the next slide, you can see some of the primary companies or select companies consolidating, in the fuels distribution area. And this, I think, this is very full group because you have the major oil companies and refiners very active and coming downstream a little bit. There's lots of great U.S. private companies, very large regionals that have gotten bigger on the right side. I've mentioned private equity on the lower right, like Court Square, who owns Often, Energy Capital Partners, which I mentioned a minute ago. And then the MLPs are still very active on the lower left-hand side, whether it's through buying, convenience store locations or moving farther upstream just for buying, businesses with wholesale businesses. They're very active, even though they're more quiet than they used to be. They may not have the multiples that they used to get, but they're healthier than ever, and they're very active in our processes.
Spencer, these major oil companies, the people who've been around in the industry a lot longer than me, they tell me these majors come in and out in cycles, and 10, 15 years ago, it was an exit time for them, and now, as you mentioned, we're starting to see them re-enter, whether it's through JVs or other creative relationships. What are they seeing in the industry, or larger factors at play for them company-wide that's driving them back into this industry?
I think it's just a matter of having a dedicated offtake for their product in the refinery system. That's what I'm thinking. I mean, they want to control.
It sounds like you're breaking up a little bit to me. I don't know, Jim, if that sounds similar, Spencer. But
how about now? Can you hear me? Is that better? Jed?
Just breaking up a bit.
Yeah.
Jed, can you hear me okay now?
No, it's still really choppy.
Yeah, you guys are choppy too. Yeah, I'm on my headset. Let me try. I'll try speakerphone. Let me see if that's a little bit better. Sorry.
Okay, thanks, Spencer.
Is that better?
No, that's still choppy, unfortunately.
How about now?
Go ahead and talk a little bit more, Spencer.
Can you hear me right now? Okay.
Yeah, it's still choppy. I'm trying to think of where the troubleshoot. What we can do.
Let me try to call in on my. If you could text me the number to call in on my cell phone, I'll do that real quick. I'm sorry.
Yeah, I'll text that to you, and if you could flip forward maybe in the slide deck, and we'll let Jim jump in just till we get your audio figured out.
Yeah, let's go up to the PPP loan slide, which is up in the 20s.
Okay.
There we go. First of all, just want to also say to Jed and the group that I'm really happy to be here today and appreciate the opportunity to talk to everyone. As Spencer mentioned, last year my partner Tammy was involved in this and provided some legal updates, and this year we decided to get some different topics out there, hopefully topics of interest to the group. And the first one that I want to touch on a little bit is just the SBA PPP loan program, which has obviously over the past year become quite a major factor for lots and lots of companies, primarily small businesses. But I would imagine there's a number of folks on the line here who have taken advantage of that or may still be in the process. So the first thing there, I guess, is that the initial round, which was kicked off back in April of last year, has widely been viewed as a great success. There was approximately $522 billion distributed through over 5,000 lenders throughout the country. That involved over 4 million different loans, averaging about 125,000 each. So they were really all across the spectrum, providing much needed capital to many companies of different sizes to get them kind of stem the tide of the pandemic, particularly in the early days. And I think it did accomplish one of the main goals, which was to avoid layoffs and other severe financial distress for these companies. So that was really kind of the first round of the PPP program, and many lenders and companies were active in that throughout the year. Late in the year, I believe it was December 27, the Economic Aid to Hard-Hit Small Businesses, Nonprofits, and Venues Act extended this program through March 31 of 2021 and provides essentially a second round of PPP loans. In this round, there's approximately $284 billion made available, which technically is available for first-time borrowers under the PPP program and second-time borrowers. As of February 7th, so the second round just kicked off in early January. I think it was January 11. By February 7, over $100 billion had already been loaned from this second round. So again, very active and so far viewed as quite a success. There are lots of similarities between kind of the second draw loan program and the initial round. For example, and maybe first and foremost, the loans are forgivable if the proceeds are used for payroll and other eligible expenses. And actually, I guess maybe we touch on that briefly. What are the authorized uses of the loan proceeds? First and foremost is payroll, and at least 60% of the loan proceeds have to be used for payroll in order to qualify for forgiveness. But some of the other more common uses of PPP loan proceeds would include rent and mortgage interest, utilities, benefits cost, particularly healthcare costs, healthcare benefits, and some sort of updated, expanded qualifying uses in this second round would include some operating costs, business operating costs, such as software and cloud computing expenses, some property damage expenses related to 2020 unrest, and expenses related to PPE and similar items such as installing plexiglass barriers here and there and sort of retrofitting your space to either provide PPE or to minimize the transmission of the COVID virus. So it does expand a little bit on the authorized uses that you can use the proceeds for and still receive forgiveness. But again, at least 60% of those proceeds have to be used for payroll expenses.
It's interesting, Jim, as Spencer alluded to earlier with the record margins that many of our study group members had. times have been good, but the definition here of if revenue declines by 25%, you qualify for PPP2. Many of our study group members do, given the collapse in fuel prices that took place. And I know a lot of folks are internally deliberating, do I take the loan even though times have been good for me? And all kinds of thought processes that go into it with something. It's better to have the money in the bank in case who knows what's going to happen in the months ahead, how long this could continue, or margins going to fall out, et cetera. But lots of different thoughts on it.
Yeah, that's for sure. And I mean, a lot of people focus on the forgivability of these loans, which of course is a huge factor, or can be. But even if it turns out that you're not going to qualify for forgiveness because of the use of the loan proceeds, as long as you qualified to obtain the loan in the first place, it's still cheap money. It's 1% money, and I believe it has a 5-year term. So I think there are some folks that we've talked to that even if they're iffy about the forgiveness piece of it, they've still decided to go ahead. But you're right, it depends a lot on, very specific details of each company's situation. And that kind of actually leads me, Jed, into some of the differences here between the second round and the first round. Technically, in order to qualify for a second draw PPP loan, you will, of course, have to have had a first draw PPP loan. But again, this just to be clear, the $284 billion that was authorized at the end of December is for both first and second draw loans. So another one of the differences here is that the covered period, in other words, the period during which you will use the loan proceeds, is a little bit expanded now. In the past, it was either an 8-week or a 24-week period, depending on the nuances of your business. And now it's up to the borrower to choose any time between 8 and 24 weeks, so a little more flexibility. Borrowers under the second round, second draw borrowers can't have over 300 employees, which is a little bit smaller than what it was in the first round. 500 was the threshold. There are some exceptions here for how employees are counted, and the regulations actually get very detailed and esoteric when you talk about affiliated entities and things. But generally speaking, the threshold is 300 employees for this round versus 500 in the first round. The next one is the point that Jed mentioned, a decrease in revenue. You would need to show a decrease in revenue of at least 25% year over year for any fiscal quarter during 2020 compared to the corresponding quarter in 2019 in order to qualify for this second round. The maximum loan amount this time around is $2 million compared to $10 million in round one. So again, highlighting the fact that the focus is on smaller businesses. You are still limited to 2.5 times your average monthly payroll expense, with some exceptions to that rule, getting up to 3.5 times for certain businesses. The forgiveness application for the smaller loans, those under $150,000, the application for forgiveness there has been streamlined quite a bit as well, just to smooth out that process for the smaller loans. And then one other aspect of this is slightly increased lender fees. I think a lot of lenders were surprised at how much money they actually made in the first go-around. Some of them are still trying to figure out what were the costs associated with ramping up for this program, but so the final word may not yet be in on how much they made, but in this round, fees are slightly increased depending on the loan size. The fees would be 5% or 3% of the loan amount, and in round one, loans over $1 million had a 1% fee. So there's a little bit of a opening up and increase in the lender fees. Another sort of material way in which this second round differs is not only a focus on slightly smaller loans, smaller companies, but providing capital to minority, underserved, veteran, and women-owned business. There's a real focus on that. this time around. I think there was some, in my estimation, that's a response to some criticism from the first round. But a few concrete things that the new act provides for in this regard is setting aside $15 billion for lending by community financial institutions, the smaller lenders. Setting aside $35 billion out of the 284 for new PPP borrowers specifically. So I think one of the criticisms that was levied with the first loan program is that the smallest borrowers, in fact those who maybe for whom it was maybe make it or break it, getting this loan in the first round, they just were less sophisticated and less on it than some of the bigger, more sophisticated companies. So this round does set aside $35 billion for those that did not get a loan the first time around. And then along those same lines, $40 billion is set aside for borrowers with a maximum of 10 employees or for loans less than $250,000 to borrowers in low or moderate income neighborhoods. So again, just some specific efforts there to try to steer a portion of this round to some of those minority and women-owned, veteran-owned, underserved community businesses. Some of the less tangible things that the SBA is implementing in this regard also is just a stepped-up effort to match small businesses to lenders who traditionally serve the small lending market, and efforts to help lenders who may not otherwise have qualified for the program to get them qualified so that they can provide those loans.
Jim, do you
and then I guess the last,
how much,
go ahead.
Money, do you have a sense of how much money is left in PPP2? Are we going to run out soon? Do people, if they want to apply, need to do it like now, or any sense?
Yeah, good question. My information on how much has been loaned out so far is approaching 2 weeks old now. So, but as of the 7th of February, approximately $100 billion out of the 284 had been loaned. Excuse me. So that's a little bit over a third. Was already out the door by then. So I would definitely say people need to jump on this sooner rather than later. And again, the window is going to close on March 31 in any event, as of now, unless that's further extended. So it's as of the 7th, there was about 180 billion left.
Okay, thank you.
You bet. Then the last little piece to just mention here is the new act from late December of last year also includes a category of loans called supplemental PPP loans. It's a separate silo apart from the first and second draw loans, and this is a silo that will be available to certain existing PPP borrowers that either gave back their loan or borrowed less than they were able to borrow under the first round, as long as they have not had their first loan forgiven. So if you got a first round loan and it's not been forgiven and you either gave it back or you borrowed less than you were able to borrow at that time, then you can step in and borrow under this supplemental PPP loan program, which I have not seen. I don't think we've had any clients that have taken advantage of this yet. So we don't have any hands-on experience with this piece. I think it's a real kind of small, unique little niche out of the latest legislation.
That's interesting. I was unaware of it. Yeah, thanks, Jim. I know you got a couple other legal considerations to talk about, but Spencer, are you back on the line here?
I hope you can hear me okay now. Can you hear me okay?
Yeah, you sound great, Spencer. So we'll jump back to you. I know we're jumping around, but appreciate your guys' flexibility. But Spencer, I just asked you the question. The majors are getting back into the downstream, and why? What are they seeing?
Yeah, I think I thought I had to address that, but I'll talk about it again. I think that they want control of their throughput, and they gave that up back in 2005 to 2008 to a large degree. And and I think that they have a lot of refinery capacity that they need to use. And the more control they have over their network, their in-net network, the more they can get the utilization of the refineries back up to where they need to be profitable. I think it has a lot to do with it. At one point, there was a RIN issue with a lot of the merchant refiners that they wanted to control, the final output of fuel too. That's not as much of a problem, but there's, I think that, carbon credits coming and things of that nature, legislatively are going to be increasing over the next few years. I think that you're going to see them, the major oil companies or major refiners, more and more doing either JVs with retailers or actually, being direct on the street and competing directly with other retailers.
That makes sense. Yeah, thank you.
Sure. So you want me, I'll go back and pick up where I left off. And unfortunately, so, this is on slide 9. A lot of times we get asked, what are the multiples? And we always reply, well, the multiples vary, from company to company, from, what your business channels are, where you are in the country, et cetera. But, and we don't like to use our own confidential information from transactions, on public situations like this or presentations, but we like to track the publicly traded companies and look at the trends of their, what we call enterprise value divided by corporate EBITDA trading multiples. And the enterprise value is for real simple, is market cap of their equity, their stock price, times number of shares plus the interest bearing debt, and divide that by their corporate EBITDA. So this graph right here shows the retail and wholesale fuels distribution companies that are publicly traded, and they're all on the table down below. And we've gone back from 2012 back to 2012 when this, what I call the 8-year bull market started, and to show the trend of these corporate EBITDA multiples over that period of time. And if we were to take this back, which we're going to show you here in a minute, you'll see it. The trading, it's much lower than previous time frames, but this 8-year bull market has been exceptional, and the average multiple has been 9.6 times. And if you look all the way to the right, kind of in 2020, you'll see kind of a dip, and then it popped back up. That was the COVID effect where we saw some share prices go down for public companies, but the EBITDA actually was really strong for these quarters, all the quarters in 20 for most. And so it really constricted the multiple or compressed the multiple in, late Q1, early Q2. And then people started to realize that we're an essential industry and we're actually going to do okay. And the market came back, especially for our industry. So that's the combination of retail and wholesale fuels, public company multiples. And so the next slide is just a more granular, a lot more detail on each of those, and everybody can look at that on their own. But here, this slide on slide 11 shows what I call the 3 waves of M&A since 1995, and it does the same thing. But this is just focused on retailers, primarily convenience retailers. Everybody seems to have a little bit of wholesale in their companies, but these are the enterprise value, the corporate EBITDA multiples for a set of just primarily convenience retailers like the Casey's of the world. And so we go back to 95 to 1999, and you can see we were in an upcycle, and we had a pop in multiples, and this was really driven by securitized lending and debt. Then we went through the little bit of a bear market from 2000 to 2005. There was a slight recession in that period of time, especially in our industry, because we had a lot of over-levered companies in our industry. Then things started to turn in 2005 to really the start of 2008. Again, it was debt-driven. This was the low doc, low security lending phase, and we saw a lot of lending, especially for individual store buyers back in that time period. Obviously, the great recession hit in 2008, and then we came back in 2012. And this is due to a myriad of factors. It wasn't just driven by lending. It was driven by the public capital markets opening back up, very favorable tax laws, incredibly low cost of capital, interest rates. So, and as we've gone through this period of time, it just seems like until now, and we'll have to see what happens under the new Congress and president. But we've had just each year it seems like there's something new that primed the pump of M&A over this period of 8 years. So it's been quite a run for people that have been in the industry, and if you've been invested in some of these public stocks that are traded, some of these public retailers, you should have done pretty well. So it provides a historical, perspective of the industry, back over, about 20 years. We often also get asked, how's the M&A activity over time? How was 2020 compared to, other years where there was a lot of M&A activity? Did COVID really push it down? And so this table here is really focused on transactions in the CNG and fuels distribution segment that we're talking about right now. And we have certain criteria up at the top that people can review on their own to be concluded in the study here. But we were just over the last, since 2012, there's been about 32 transactions that met the criteria above. That means they were substantial enough to be included. And so in 2020, we were at 30, so we were just 2 off based on our research and the records we keep. So it was a good year, and a lot of those deals closed in the later half of the year because there was a little slowdown between April and June. But a lot of deals got done, and one of the neat things about this is that there were, over between 2018 and 20. Of the 108 transactions, there's 66 unique buyers. So it's not the same buyers doing all the acquisitions. I mean, we have a lot of different types of buyers, and I don't have a table in here about that, but we chart that, and whether they're private equity or private or MLPs or whatever the case may be, it is diversified for this industry. So it's good, it's fun, and there's still a lot of good acquirers out there wanting to grow. And a lot of times we get questions of, well, how can these larger companies pay these high multiples, these high corporate level multiples for these transactions? And so we have gone back and studied where public companies have announced, how are they going to get synergies in transactions to be able to pay what they're paying, and then try to do the math to figure out, well, if it's reported they paid a 13 multiple, what do they really think it's going to be after they achieve their synergies? And then oftentimes we'll go back and see if they've achieved their synergies, and that's a little bit harder to prove. But this table breaks down the different synergies that these acquirers are saying that they're going to achieve, right? And so back on the left side, Energy Transfer, Susser Days, and the Speedway, when they bought Hess, they were very detailed about how they were going to achieve their synergies. And as we've gone along, as you go to the right, they're not disclosing it as much by segment, but they are giving numbers of total synergies that they think they can achieve. So if we go to the right and look at the Murphy USA acquisition of QuickCheck, they paid reportedly $645 million. And that came, if you look at the next line down, to a multiple of 13.7 times the corporate EBITDA of about $47 million. And you look, as you go down that column, it was, Murphy mentioned that they think they could achieve $28 million in synergies, which is a little bit around 60% of the $47 million of EBITDA that they're already getting. So when you add that 28 to the 47, they're saying, well, we're going to make QuickCheck a $75 million EBITDA company. And you divide that into the 645. So really, we only paid 8.6. So, when buyers go out and look at opportunities, and they do share synergies. They don't give all the synergies, but they do give certain synergies in the purchase price to be able to be competitive to get the transaction. And that's what this table is trying to show. And there's a big disparity between these transactions because these are large transactions involving public companies versus, maybe a private transaction. But and so you can't just take this multiple and say, I'm going to get 13.7 on my company. Every company is different, but these are large companies that were very coveted by these acquirers. So I think that's really pushed the multiples up before synergies. I'm going to skip this slide. It's an interesting slide about the resiliency of our industry, and we wrote a capital markets perspective on this, and it's on our website. I encourage people to download it because it'll make you feel good about the industry we're in and how resilient it is. So you can go to our website to get that. I'm happy to talk about that as well if you want to give me a call. But now we're going to move to propane. And so many of the factors affecting CNG and fuel distributors are also driving consolidation in the propane market. And that's low cost of capital, tax advantages for buyers, low tax rates for sellers. All that is the same. Generational issues, it continues on. But in the propane industry, they're also being affected by electrification and the expansion of natural gas. And I don't think that's a surprise to anybody here. And it's strange, but sometimes propane is also perceived as a dirty fossil fuel, which it certainly is not. So it's very interesting, why consumers convert from propane to electricity, or natural gas. Some of it's just pure convenience. But we've had, record natural gas production with the shale plays over the last few years. And so utilities like the Chesapeake's, Energies of the world, they're continuing to expand their pipeline distribution systems. Sometimes they lead with propane acquisitions to get market share, and then they bring a pipeline into that area and, convert to natural gas and have both propane and natural gas customers. So it's a very interesting model, and there's other utilities that do the same thing. So, and I think the other thing that's driving a lot of the selling is even though we've had pretty good heating degree day numbers the last 2 years, if you look at the 10-year average number for heating degree days over the last 30 years, so if you look at that rolling average, it's gone down significantly. I mean, it's the charts are. If you have a chance to look at some of those heating degree charts over a 30-year period, it'll make you think very hard about climate change because it's very different than it used to be. So the shale play over the last few years has been incredibly good for propane marketers in terms of margin for what they get for retail margins and wholesale margins. And we've seen cash flows from private propane marketers stronger than ever over the last few years. And hopefully that'll continue. But I think there's going to be pressure because more and more propane is starting to be shipped overseas in the form of liquefied propane. So that's going to put pressure on the supply in the U.S. for that. You go down to 16. We've listed some of the companies that are driving consolidation. It's a very similar industry as convenience store and gas or fuels distributing. It's a lot of private companies, very good companies, whether family owned or private equity backed. Very sharp group of people in this industry, and we've enjoyed working in it. And when I talk about international companies coming in and growing, as I mentioned before, if you look down in the lower left, we have 3 that are prominent. They're not the only ones, but they've been very aggressively growing. Superior's done a number of acquisitions. I know I got a chart here in a minute I'll show you. DCC and SHV out of the Netherlands who bought Pinnacle Propane. They're all looking to grow. They like the industry. They like propane in the U.S. And Jed, I can't answer the question you want to ask. Why do they see more growth than others? I think they see it in scale, but I don't know, exactly what they're seeing versus, what other people are seeing in the U.S. here for these international companies. And I do know that Pinnacle, for example, has really run out of a lot of growth opportunities in their propane division in Europe, and so they view just the U.S. as a growth opportunity in general for them. The next slide 17, is select, propane M&A activity over the last 12 months, and you can see it was a very busy M&A year in 2020. So it shows you that COVID didn't affect this industry either. I don't think there would have been much more. I really don't think COVID cut it in half. I don't think there could have been 30 or 40 transactions last year. I think everybody was very busy that I know that's working on deals and transactions and talking to the acquisition or development officers in these companies. I don't think they could have gotten many more deals done. So you can see on this list who's been very, very busy. Interestingly, the multiples for the publicly traded propane and refined fuels distribution companies has gone down over the last few years. And this is a hard chart because there's a very different product mix for the public companies that are in here. And we've had a couple that have been deactivated or gone private, and it's kind of affected the public multiples. But this trend diverges from what we're seeing in private market M&A. We're getting stronger multiples for very good propane companies, stronger than we typically get if they have the right quality of gallons. So it's an interesting tale. Sometimes the public company multiples don't tell the story of what's happening in the private M&A sector, and this is a good example of that. Here's some more granular detail on the publicly traded companies today that are primarily propane retailers. And now we'll go to lubricants. And so if you were on this seminar last year, or webinar, I'm sorry, there's not a lot of change here. I mean, the consolidation story continues with lubricants. As I noted last year, the number of lubricants distributors has decreased significantly over the last 10 years. And it's just really comes down to that the leading suppliers want to work with distributors that are larger, who can provide more services, who can provide more sophisticated handling of their these lubricants that are, not to use the same word again, more sophisticated and fragile. They want storage for the type of lubes that you can support longer service intervals and greater fuel efficiency engines, and they're just different types of lubes. So also we're seeing that with all the industrialization talk and infrastructure investments that we expect the Biden administration to make over the next 4 years, we think the demand for lubricants is going to continue to grow, and it has been very positive. It's been around 1% to 2% growth in lubricants over the last couple of years, and projected to be over 2% for the next few years. So we'll see more consolidation because there's a growth story here under lubricants. So if you turn to the next page here, I'll move the slide deck 21. You can see some of the companies that are driving the consolidation in lubricants. Not as many well-known in this industry, but some of the names that you'll see on the other slides as well. And there's been a lot of private equity activity here with the Relodyne and PetroChoice being backed by two larger private equity funds. And but some common names here: Pilot Thomas Logistics, Mansfield, Diesel Direct. All of these companies are growing significantly in lubes. The last slide I'd like to talk about, Jed, is the potential tax impacts that we could be seeing, and what we think would be 2022. We can't project, how severe the tax law changes are going to potentially be, but what we did here is we created 3 scenarios of a hypothetical transaction where we had a company sell for $120 million in an asset sale, and it's a passive entity, an S corp or an LLC, and the tax basis of the assets sold was about $30 million. So these are assets that have been depreciated or held for quite some time. And so what we're hearing, is that the initial reports, we had the federal income tax rate increasing from, say, 37% to 39.6% for individuals making over $500,000. We additionally could have the capital gains rate for individuals making over $1 million. That could increase from 20 to 39.6%, which is a very big jump. But we think somewhere in the middle is most likely. So we built a model that the scenarios on this hypothetical transaction. If you look to the left, the current 2021 tax rates, based on the federal income tax rate of 37%, a long-term capital gains rate of 20%, and state income tax of 5.75%, and an allocation of this purchase price over those assets, which is too granular to get into in this presentation. The the total tax we came up with under today's tax rates was about $30.7 million with a, net after-tax proceeds of $89 million. In our best case scenario, where we see the federal individual income tax rate go to 39.6%, so up 260 basis points, and long-term capital gains going up to 25%, state income tax would just keep the same because states vary. If you go down and you look at the taxes due under this scenario, same allocation, by the way, of the purchase price over the assets, the taxes due under these different tax rates would be $34.8 million, which is an increase of $4.1 million. So your net, what you're going to net in your pocket under this scenario would be, $85 million versus the $89 million under today's tax rates. If things get more aggressive, and then this is the worst case scenario where all the way to the right, potential 2022 worst case scenario, federal income tax rates go up to 39.6%, long-term capital gains go to 39.6%. Again, this is the worst case. The tax liability will go to $45 million, or different over the base case of $14.3 million. So your net would be 74 versus the 89 in today's tax rate structure for $14.3 million deficiency versus today's taxes. So it's real money. The middle scenario is real money. This does not take into account some of the other taxes like the 3.8% net investment tax due. There's a lot of little taxes that we could put in here and into our model and affect run a bunch of different scenarios. But we run these scenarios for our clients along with our tax accountants to show that if you wait maybe too long, or if if we're not successful at negotiating a tax allocation that's really aggressive, we could be giving up dollars as we wait and the tax law changes. So just something that to consider as we move forward.
And Spencer, just quickly, best case scenario here has a tax increase. So that's your best case. So you don't see a situation where taxes would remain unchanged.
We're not tax experts or prognosticators, Jed, but I mean, everything we see is that tax rates are going to go up. And if they may not, I mean, he could wait longer because of COVID and give people more time, give the economy more time to turn around and jobless, claims to go down. But we think that tax rates are going to go up somewhat, and we hope it's minimal, certainly.
And on the industrial, commercial, wholesale fuels and lubricants, do you have any multiples that you've seen there?
It varies significantly, as you know, Joe. I mean, on short truck business where there's higher margins and customers can be stickier. We've seen it range from 4 to 8 times depending on the size. Transport multiples tend to be lower, especially a lot of those clients or customers they're not bound by contracts, or the contracts are very long. They're spot-natured business and lower margins. So it really depends. It's a wide range. And so, if you want to, on the very, very low side, you could go see as low as 3 times. But I've seen as high as 8 or 9 times depending on the size of the deal and the makeup of the gallons and how it's delivered.
Thanks. Yeah, that's helpful. And one last question for you, Spencer. Looking ahead, multiples with potential tax increases that are coming. We talked a little bit about some of the factors that could change, like interest rates, et cetera. What's your best guess of what we'll be seeing in the next year or two? Similar multiples to today, higher, lower?
I think the primary thing that drives multiples is really cost of capital, and that should stay low. There's plenty of capital availability, and interest rates don't seem to be going anywhere for quite some time. I am worried about the tax law changes. The tax laws today are very beneficial for both sellers and buyers. We're going to lose, unless they continue to keep it, the bonus depreciation, as I mentioned before, on the 15-year makers for convenience store, the buildings. You can still do the makers 15, but we're going to lose the accelerated depreciation. And we've done a model that we've done an analysis of that, and we've shown it in many different presentations of how that can lift the multiple that a C corp pays, and also a C corp. If the C corp tax rates go back up, they're going to, that's going to put pressure on the multiples that they can pay, right? Because they're not going to get as much cash flow from the deal. So I do worry about, a lot of public companies are C corps, and a lot of those are doing the consolidation. So if that tax law changes significantly, it is going to put pressure on multiples. I just don't know what the timing is going to be on it.
Makes sense.
But I don't believe they're going to fall back to, back where they were in the early 2000s. I really don't, because cost of capital is going to be low and for a while.
Makes sense. Thank you, Spencer. And Jim, I know we've had some technical difficulties. We're a little bit over in terms of time, but just a couple points on your end that you wanted to get here just in a few minutes.
I will run through those. I don't know about the rest of you, but I could listen to Spencer talk all day about this stuff.
Absolutely.
Let me touch briefly on a couple of things that we see in these M&A transactions and purchase agreements. First, I guess what I'll hit on briefly is just Hart-Scott-Rodino overview. A lot of people, I'm sure, have heard of this, referred to generally as HSR, and it's all about antitrust. That's the thrust behind it. What it does in transactions where it applies is that it requires a filing with the FTC and the DOJ, and a review period during which they will review the specifics that are filed with them about the parties themselves, their businesses, the size of the transaction, what it's structured like, etc., to determine whether or not they have any concerns with it from an anti-competitive standpoint. It does not apply to all transactions. Obviously, it kicks in when you've got a deal size that meets the threshold, which is currently now, it's still $94 million until the new level kicks in, which I think is mid-March, and that's $92 million. So any transactions above that size, where you also have one party that has assets or annual sales of at least $184 million, and another party with assets and annual sales of at least $18.4 million, then the filing will be required. So it has limited applicability, but when it does apply, it's a critical part of the transaction, and big potential penalties if you fail to do the filings you're supposed to do, or if you close the transaction before the end of the waiting period, or in some cases, even if you sort of act like you've closed the transaction. In other words, the buyer is effectively starting to run the seller even though the deal hasn't closed. You can be setting yourself up to some potentially significant penalties there. Given the brief amount of time here, I'll let that go, and obviously happy to talk people through any and all of these things in more detail post, after this is done. If you want to reach out, give me a call or an email at any time. The other piece that I'll touch on before we wrap it up is reps and warranties insurance. As I'm sure a lot of folks are familiar, purchase agreements contain sometimes very significant, usually very in-depth reps and warranties from the seller about the business. And buyers rely on those reps and warranties to some extent in closing on the transaction. And the seller usually in the purchase agreement will indemnify the buyer for damages that the buyer may incur as a result of a breach of those reps and warranties. A frequent way of making sure that, buyers want to make sure that the seller doesn't sell and take the money and run, and that there's something there to fulfill that indemnification obligation if it should kick in after the closing. So frequently, a portion of the purchase price will be held in escrow, backed by a letter of credit, some sort of mechanism to make sure that there's going to be something there to satisfy those indemnification obligations. And rep and warranty insurance is just another vehicle to do that. For a buyer, it provides some certainty that I've got what is a strong credit. The insurer itself is backing these reps and warranties now and will cover covered breaches. And oftentimes the risks of a seller breach of reps and warranties can be covered for a longer period of time through rep and warranty insurance. Policies are often out there for something like 4 to 6 years, maybe longer in some cases, whereas a lot of purchase agreements provide for anywhere from 12 to 24 month survival periods for reps and warranties. So you get a longer coverage period as well as a buyer. And, I won't get into a whole lot of detail. I guess one thing that rep and warranty insurance does do for the seller is that it can decrease the amount of money that needs to be held in escrow or eliminate it because the seller can say to the buyer, look, your potential exposure is covered by insurance. So again, lots of other details we could talk about, but I know we're a little short on time. I'm not sure, Jed, if there are any other questions or things we want to address before we wrap.
Yeah, let's go ahead and wrap up here. But Spencer and Jim, really appreciate you guys. I know you're showing some of the deals that collectively you guys have worked on together over the course of the past year. I'll send this slide deck out along with the recording to everybody, and I know Jim and Spencer would be very happy to visit with you on any additional questions you may have about your businesses and M&A activity and what we need to do to be prepared. So hope you found this very educational. No two brighter guys out there as it relates to this topic than Spencer and Jim. So thank you both, and hope you all stay warm and have a very good day. Goodbye.